It's tax time again.
Higher land tax.
Australians have been hit with the biggest tax increase in the world.
Promising tax cuts for all.
Yes, my friends, pucker up your buttholes. It's that time of the year again. Tax time. And the ATO are coming in hot. No lube required.
There's always time for lubricant!
Every year, Australians are clamouring to get their share in the billions of dollars that the ATO refunds on an annual basis. And it's on us to ensure we get as much of that back as humanly possible. For me, I'm a FIFO worker, 13-hour continuous days followed by a week off to spend with my small family. This doesn't leave much time to learn about finance, much less the Australian tax system. This shit is fucking hard. So I've created a video to hopefully help some of you that might be in the same boat. Please note, this video will only be touching on some of the deductions related to your employment. There is an enormous amount of tax minimization strategies you can employ to any property, stock portfolios, and the like. But for today, we're sticking to your employment. So let's get to it. A big chunk of your return may stem from your vehicle usage, assuming you meet the criteria to be eligible. To claim on your vehicle usage, you must fit one of the following. You travel from home or your normal workplace to an alternative workplace, and then either back to your normal workplace or directly home. I know, sounds complicated, doesn't it? I'm sure they do this shit on purpose. But moving on, if your home is the base of employment, let's say if you were self-employed, you start work there and travel to your workplace to continue your work. Or, and this is a common one, you use your vehicle to carry bulky tools or equipment that you use for work and can justify that there is no secure, safe place to leave them on site. Just be sure to make a note to yourself as to why you deem no safe place to leave it. It's handy to keep information like this in a physical diary, or as I do, simply in the notes of my phone. You don't want to be fumbling and bumbling if the ATO come asking questions. And lastly, if you are what they call an itinerant worker. An itinerant worker is a worker who has shifting places of employment. For example, let's say you're employed as a sparky, an electrician. You're required to work at several locations a day on a regular basis. You are an itinerant worker. On the contrary, let's say you are a builder's labourer and you work at one site for months before moving to another. You are deemed not an itinerant worker, therefore not eligible to claim. According to the ATO, the most common mistakes made when claiming on your vehicle usage is a lack of evidence. Again, keep a physical or digital diary of what you are doing and spending. Record keeping is huge. You don't want to be fumbling and bumbling when the ATO come asking questions. Also, the discrepancy between private and work-related use of your vehicle. There's currently two methods available to calculate your vehicle expenses. The cents per kilometre method and the 12-week logbook method. Under the cents per kilometre method, you must make a reasonable, reasonable estimate of the kilometres travelled up to a maximum of 5,000 Ks and multiply this by the current at the time of recording flat rate of 85 cents per kilometre. As with any of these deductions mentioned, if you are watching in the future, just double check these rates haven't changed and also check with your accountant. Under the logbook method, you could claim some of the costs of running your vehicle, like depreciation of that vehicle, interest on car loans if you've taken out finance, servicing, repairs, tyres, you get the drift. The logbook method is more work, but probably worth it. What you want to do is purchase a logbook from your nearest newsagent and record your work-related activity for a continuous 12-week period and keep records of all the previously mentioned costs associated with running your vehicle. Once you've done this, you won't have to do one for another 5 years unless you change your employment or your vehicle, in which case you'll have to start a whole new logbook. And these deductions can be worth thousands of dollars. And considering the fact that when we fill up these days, your car isn't the only thing needing lubrication, the logbook method will more than likely be the best way to optimize your return. Remember, give as clearer information as possible in that logbook. If the ATO goons come knocking, which they might, you don't want to be pissing around trying to justify your expenses. There's a link in the description for all the employment-related deductions spoken about in this video. Be sure to check it out for more details. Now to travel costs. When you incur travelling expenses whilst carrying out your work or travelling from one workplace to another, they are deductible. Vehicle expenses, air, bus, taxis or car rentals all fall under this banner. Accommodation and meals on work-related trips away may also be deductible. Keep in mind, when it comes to this sort of thing, again, you always want to keep your nose clean with the ATO. And in this case, you need to apportion the costs incurred through your work-related activities separate to those of your private activities. If the ATO come looking for a please explain, you need to justify your deductions. Again, you can do this by keeping a physical or digital diary in your phone or by taking advantage of the ATO My Deductions app available on their website. I personally don't use it, but apparently it's pretty handy, and it's a one-stop shop to store all information, receipts, and records relating to your tax return. I'll have a link in the description below if you want to check it out. Okay, now to your work clothes or your uniform. They may also be tax deductible. To claim on this, they must fit one or more of the following criteria. Be PPE in nature, which is personal protective equipment, to be a compulsory uniform to be worn at work, or a non-compulsory uniform that has been entered into the Register of Occupational Clothing by your employer. If your work clothing satisfies one of these, you can claim the cost of washing and drying of the items as well. If you do your own laundry, you can claim $1 per load, or 50 cents if other laundry items are included. If you claim above $150, you must substantiate, prove your claim. Bear in mind, the ATO states that there must be a clear connection between the clothes in question and your employment. They have to be distinctive and unique to your workplace. For example, a businessman wearing a suit and tie, or a person working for a fashion label simply wearing that brand, these things aren't deductible because they can be worn on any occasion. They are not unique to that workplace. Now let's look at your home office. With many people, possibly your spouse, are now working from home, you may be able to claim the cost of buying gear and the upkeep of that office, even if it isn't set aside solely for work. According to the ATO, there are two methods to claim on this: the actual cost method and the fixed cost method at a rate of 67 cents per hour of work-related time in the office. For the actual cost method, you may be able to claim on the work-related portion of your home office furniture, fittings, and equipment such as desks, chairs, and computers, etc. If the item costs less than $300, you can claim the full amount. If it costs over $300, you can claim the depreciation of that item. You can claim on your phone if you, for instance, have to ring your employer, clients, or students while you are away from your workplace. Remember, if you have already claimed your phone for work, you can't claim again under your home office. That would be considered double dipping and may attract some unwanted attention. Internet, printers and cartridges, stationery, the cost of heating, cooling and lighting your home office that is over the amount you would ordinarily pay if you did not work from home can also be claimed. The only downfall of this method is you will have to calculate the percentage you have used the item for work-related purposes and how much was for private use, and keep a record of how you came to this conclusion using a 4-week diary entry. Generally, if you feel you have not incurred many work from home expenses, the 67 cents per hour method might be the best way to go. But if you feel you have incurred some substantial costs, just like your vehicle expenses, it would be wise to keep records of all your costs and hours worked, do the math on both options, and choose the best method when you, or preferably your accountant, prepares your tax return. Although the 67 cents per hour method sounds easy, it seems we may be leaving some money on the table by doing this. It's estimated that some people might be understating their claim by as much as $1,500, as you cannot claim on your internet, mobile and home phone usage, webcams, office furniture and computer consumables if you use this method. Remember, as of March 2023, the ATO requires you to keep a diary of the actual number of hours you've worked from home, and it's just a good idea to do in general. Other work-related expenses not mentioned yet you may be able to claim on are things like briefcases, calculators, personal organizers, diaries, logbooks, income protection insurances, interest on money borrowed to finance work-related activity, overtime meal expenses, postage, professional seminars, courses you may have attended, but they have to relate directly to your current employment. That goes for conferences and workshops too. Reference books, stationery, subscriptions, sun protection, tools of the trade, and union fees. Again, just remember, with any and all of these deductions, you need to justify a clear link to your income producing activity. So it doesn't matter what system you use, whether it be physical diary or the ATO Deductions Tool or the notes of your phone, just make sure you use something. Every time I purchase something I think may be tax deductible throughout the year, I just take a photo of the receipt and put in the notes on my phone with a very brief description, and then file away the actual receipts with the others. Gone are the days where we would show up to our accountant's office, give him a shoebox full of receipts, slap him on the ass and say, do your best. You make him work too hard to prepare your return, you'll be paying the freight. In fact, it's a good idea to refer back to your diary or your notes and make a typed up summary, maybe in Excel or something similar, so he has something to work off. A lot of the time your accountant doesn't need to see your receipts, he just needs a summary of your expenses and some assurance that you do actually have the receipts. Don't try and bullshit your way through your return. The ATO are clamping down harder and harder. It's not worth the stress. Also, remember, claims up to and more than $300 require written evidence, such as receipts and bank or credit card statements. Generally, you will have to keep this written evidence for 5 years. They can be hard copies or electronic. If they are copies, they just need to be clear copies of the originals. Okay, the last thing I'd like to mention regarding your employment-related deductions is your salary sacrifice super contributions. So it's quite common for employees to set up a salary sacrifice scheme. That can be beneficial to both lowering your taxable income and just adding to your retirement nest egg. When you salary sacrifice to your super under an effective salary sacrifice arrangement, it's considered to be employer contributions, which is taxed at 15% instead of your marginal tax rate, which is somewhere between 30 and 45% under the newly revised 2024 to 25 tax rates. For example, let's say your wages or salary is $130,000 per year. Your employer will contribute roughly $15,000 towards your super. This will leave a $15,000 gap between the cap of $30,000 being the maximum before tax contributions you are able to make before that concessional 15% tax rate turns into your marginal tax rate. Let's say you salary sacrifice $200 per week from your before tax wages, which is roughly $10K. That $10K will be taxed at 15%, leaving you with $8,500 in your super, as opposed to that $10K being taxed at your marginal tax rate of 37%, which is $3,700, leaving you with only $6,300. That's $2,200 difference, better off in your pocket. And according to the current tax rates, once you go $1 over that $130K a year, that 37% increases to 45%, making it all the more worth it. Sacrificing that $10K from your wages means your taxable income at the end of the financial year has been reduced from $130K down to $120K. A few things to note if you are considering salary sacrificing. As mentioned before, there is a cap, a maximum in which you can contribute to take advantage of this 15% tax rate, which is $30,000 at the time of recording. This includes your employer's contributions. Your super fund should be able to help you work out exactly how much you can safely add to your super before exceeding this cap. But keep in mind, if you do exceed the cap, you won't all of a sudden be hit with your marginal tax rate for that whole $30,000. You only pay the rate on the amount that exceeds the cap. You also won't have access to the sacrifice funds until retirement age, which is currently 65, but who knows where they're going to move the bloody goalpost in the future. Another important note, for those of you on a decent pay packet, especially you underground workers, the tunnelers, the miners making that cream dollar bill, y'all.
No, Dad, please don't ever do that again.
If you make over $250,000 of taxable income, the ATO will pull the old Division 293 out on you. Yeah. Remember the old Division 293 chestnut? Now seriously, it is a thing. And what this means is you will pay 30% tax on one of two things. Either on your total super contributions for the year or the amount of taxable income you have exceeded over the $250,000 threshold. This amount includes your super contribution, whichever is less, thank God. And let me attempt to paint the picture to try and give you a clear understanding of what I mean. So let's say I'm a FIFO worker. I've got some deeply rooted mental issues because I've been doing this shit for way too long, but that's another story. I've earned $280,000 and have 20K super contributions totaling $300,000. Option 1 looks like this. 300K is $50,000 over the threshold. Option 2 is the $20,000 I have in total super contributions for the year. The lesser amount is obviously the super contributions at 20K. 30% tax needs to be paid on this lesser value. Considering you have already paid 15% on this, you need to pay the outstanding tax of 15%, which is $3,000. Keep in mind, this all-up rate of 30% is still much nicer than the 47% tax rate if you are in fact inside this bracket. One more example. You know Chriso, the new TW1 worker on your crew? Yeah, that guy says, yeah, I can operate a jumbo, a bogger. Man, I've been doing underground work since I was knee-high to a grasshopper. Bruh. Brother can't even drive a bobcat. Every crew has one. Nonetheless, he has made $240,000 and has $20,000 super contributions for the year, totaling $260,000. Option 1 looks like this. He's $10,000 over the threshold. And option 2 looks like this. Super contributions of $20,000. The lesser value is the $10,000 he has crept over the threshold. He will have to pay an extra 15% on that $10,000. If you are in this category, don't worry, the ATO will very conveniently send you a letter outlining the balance to pay. They will also give you two options. You can either pay in cold hard cash or elect to have this paid from your super. Now guys, keep in mind there is an enormous amount of ways you can go about legally minimizing the amount of tax you have to pay, depending on your situation. The things I've touched on in this video relate purely to your employment. I'll look to cover some more tax strategies in the future regarding investment properties or possibly being self-employed. Comment below if there are any particular topics you would like me to cover. If you are earning income in Australia from the lower $50,000 up to the pointier end of $300,000, you are paying anywhere from $7,000 to over $100,000 respectively in tax. Although tax is a critical part of running a civilized country, these guys do not need any extra donations. Educate yourself around the tax laws here and put more of your hard-earned back in your pocket. And remember, finance is just a game. It's your turn.